All right, hi everybody. My name is Richard Lesperance. I go by the name of my man Richard. Welcome to a better lifestyle. This is part two of my conversation with John in regards to the tariffs that has been imposed lately. So that and real estate. So John, what do you think is are we heading into a correction in your on your side? What do you think?
I mean, it's looking that way, right? I think right now there's still just so much uncertainty. In fact, if you saw what happened, earlier this week, we're recording this on April 9th. A rumor was started that Trump was going to pause these tariffs from implementation for 90 days, and it was totally unfounded. It was just somebody tweeted that we're hearing that Trump is going to pause, and the stock market shot up like 1,300 points, and then word came in, no, Trump didn't actually say that. They're saying they're not going to negotiate, and the stock market plummeted again. So, it's kind of a hard to say at this moment, just because we're sort of sitting in the middle of it, and it's a little unclear exactly what the long term strategy is. I think a lot of people felt that Trump's negotiation style was to go in very hard and aggressive, say we're not negotiating, this is what it is, with the hopes that all the countries around the world start knocking on his door saying like, we want to work with you. We want to solve for this and start negotiating. So I suspect that is happening behind the scenes. But point is that I think if you look at tariffs, they will absolutely be inflationary. At the end of the day, companies may temporarily hold back on raising prices just to see how things play out. But businesses aren't in the business of losing money. And at the end of the day, a tariff on a business is going to be passed through to that consumer. So you're seeing it today with behavior, right? I read an analysis today that, a lot of staples, I mean, things like toothpaste and paper towels and toilet paper and all these things people are starting to panic buy and hoard under the expectation that those prices will go up. So, the reality is we have a recession generally every 5 to 7 years in the U.S. It's just sort of a normal thing that occurs, just a contraction. When you think about any economy, especially, the US economy, but then add to that the global economy, there's trillions of inputs. And so, it's hard to predict, right? And so I would say, yes, we are heading towards a correction. I think we're in one now. I think if something doesn't happen with these tariffs in the next 30 days, we will definitely be in a recession in Q3. Now, I say that's just me reading economists and looking at what the JP Morgan and, the big investment banks of the world are saying. But I think we were sort of overdue for a recession. I think this is just speeding up the time in which we'll get to it.
So do you think it's a good time for people to get into the real estate or maybe stay on the sideline for a while to see how things play out?
Yeah, so my view is that specifically when we talk real estate, that can mean a lot of things, right? So it could be retail, it could be industrial, it could be office, or it could be residential, right? And so I would say residential real estate is where I would be thinking if I were an investor today. Now, I'm in that business. So, of course, I have an interest in that statement, but I would say that even if I took myself out of that, there's a really interesting chart you can find very easily. So for the listener, if you just go to Google and type in Federal Reserve Bank US rent chart, you'll find it very easy. It'll be the first thing that comes up. And the chart goes all the way back to like 1930. And I think it might even go back to 1920. It's been a couple of days since I looked at it. But what's interesting is when you look at the rent growth in the US, the only time there was negative rent growth was at the Great Depression. And the only time it flattened out nationwide was during the first year of the Great Recession. So if you look over that, nearly 100 years of data, rent has always gone up in the US. And real estate is generally considered a good hedge against inflation because as inflation occurs, the value of the buildings typically go up. So you've got, just sort of your organic appreciation that just occurs as you own a piece of real estate. So let's just say you bought a piece of land and didn't touch it. Generally, that land's value will go up with or even above in the inflation rate. So it's considered a good hedge against inflation for that reason. But specifically, when you look at multifamily or residential real estate, once again, there's only been 2 times in the US history that rents have gone down. And I think combined with a few factors that the tariffs are going to impact, existing buildings are a really great investment. And the reason for that is that the cost of building a new single family home in the United States went up 40% from 2019 to 2023. These tariffs will probably increase that by another 10 to 15%, potentially more, depending. And so when you factor that in, to build a new building just got a lot more expensive. And over the past 4 or 5 years, it's already gotten much more expensive. So when you buy an existing building that was built at a lower, just cost because the materials cost was lower, and then the investment you invest in, whether it's a single family home that you're maybe buying, or maybe you're investing in some shares of a multifamily building in a syndication like we do, you're forcing appreciation by improving the quality of the building. So a couple of investors have asked me recently, well, won't the tariffs impact you guys, right? You're doing renovations, you need materials. The good news is we're not doing major heavy renovations. We're putting in new countertops, we're putting in new appliances, we're painting cabinets, we're putting in new flooring. So we do anticipate our costs will increase, and we're underwriting that into our new deals. We're absolutely netting up the per unit renovation cost on any future deals we do. But it's not like we're building a new building from scratch where we're talking about lumber, steel, aluminum, all of these materials that are going to be heavily tariffed. Like, most of our lumber comes from Canada, or Brazil. Most of our steel and aluminum comes from China, and other countries. We do manufacture some steel and aluminum in the US, but very minimally. So the newer construction builds are going to be just so much more expensive, which means that in order to make them profitable, they're going to have to charge more in rent. So I think 2 things are going to happen. You're going to see very expensive Class A buildings being built with high rents, or you're going to just not see a lot of new development at all, which is more likely what we'll see. And so when there's limited inventory, which there already is in the US, depending on who you ask, and I think the National Association of Realtors just said we're about 4 million homes shy of where we need to be just in single family homes to keep up with current demand. Then you add in the lack of multifamily apartments. It's just going to be this kind of perfect storm where to build a new building is going to be way more expensive. There's already limited options for renters and for owners. And so existing buildings values, I think, are going to increase pretty aggressively over the next 5 to 7 years. So we're betting big on real estate. So for me, I would say, I know for me personally, I invest in all of our deals personally at Ferris Capital, but I'll also be looking to place my investment dollars in other real estate deals, even outside of what we do. And just watch and see what happens with the stock market for the next couple of months. I think we're going to see a lot of turmoil, a lot of ups and downs, a lot of big swings in either direction. And so, when I think about the stock market, my thought is that's money for retirement. I said it and I forget it. My financial planner keeps an eye on things. We occasionally make a move, but I'm investing in really great companies that have long track records of success that'll be around a long time. So, I'm 44. I don't think about that money until I'm 65, kind of an approach. But when it comes to wealth generation, I'm thinking about real estate specifically, 100%.
So if someone, let's say, you mentioned for multifamily and flipping, but if someone is going into buying a single home, like a single family, with interest rates that might go down, they say, like, correct me if I'm wrong, when interest rates go up, the value of the house goes down, and the opposite is when the interest rates go down, then the value goes up. So what do you have to say about that?
That is historically fairly accurate. But what's interesting is, we were just in an environment where there were 2 and 3% interest rates. And so rates effectively doubled or tripled, last year, really starting in 2022, 2023. And if you watch what's happened, real estate values have gone up tremendously, even with those much higher rates. Now, a couple of things I think it's important to realize is that the rate environment we have today with 6% mortgages is actually the historical average over the last 30 years. So it's not as if they're really high. They're just high as compared to where we were the previous number of years. And our rate stayed low for a really long time, which is very unusual, really, to dig ourselves out of the Great Recession. Then the pandemic occurred, right? So there was a lot of reason to keep those rates low. I don't think we're going to get back to that kind of a rate environment, but it's possible. But the difference, I think, this time is if we lower rates back to 2 or 3%, it's a sign that we're in a deep, deep recession. And so you may say, "Oh, great, rates are low," but you may be, seeing less income growth. You may be seeing more unemployment. You may be seeing some things that will have adverse effects on the greater economy. So, wishing for lower rates right now may be actually wishing for, some pain. And so, certainly low rates are great, but, lower rates typically mean a problematic economy. So I think we were a little spoiled, in other words, the last number of years with these lower rates. But once again, the lack of inventory has caused it to where even though rates have gone up dramatically over the last few years, the home values are still increasing dramatically as well. Because think about it, if I bought a home, say 5, 6 years ago with a 2 or 3% interest rate, and then I'm thinking about buying a more expensive home at a 6 or 7% interest rate, my monthly payment is going to go up dramatically. The amount of interest you're going to pay over the life of that mortgage is going up dramatically. And so a lot of people are making the decision to stay put and stay in their home. And I think as we move in towards a recession, that's going to just be even more incentive for people to stay in their homes. So prior to the Great Recession, say up until about 2006, 2007, the average homeowner traded their home every 4.5 to 5 years. Today, that's looking more like 10 to 12 years. So people are just staying in their homes longer. There was also this idea that a lot of the baby boomers that were retiring would sell their homes and move into apartments or condominiums or maybe townhomes. And that really hasn't happened. So we just have an extreme housing shortage. So I think it's hard to kind of look in the past and say, oh, what happened before will happen again, because we're just in a much different world now with that lack of inventory. So I think as rates have gone up, you've seen home values go up. So if rates go down, I think you'll still continue to see home values go up. I've even heard one guy, and I'm not saying he's right, but he's an economist in Europe and he's in England, actually London. And he said he wouldn't be surprised if home values in the US and England doubled in the next 5 to 7 years again. That's just one gentleman I've heard say that. So I'm not taking that to the bank, but it just shows you this lack of inventory now combined with the high tariffs is going to make it very difficult for builders and developers to develop new single family homes or multifamily homes, which will put more pressure on rents and home values, and they will increase. So once again, that's why we're betting on, apartment buildings as an investment today in a big way. In fact, our biggest challenge is there's just not a lot of good deals out there right now. So any good deal we see, we dive on top of it, and we're fighting tooth and nail to win it. So we're heavily betting on residential real estate at Ferris Capital Partners today, given the current climate.
So what's your strategy now for these 9 months now in regards to everything that's happening? Because we're saying Trump is saying short pain for things to get better, like it might turn around, like it might last for 4 or 5 months, but now we're in April now. So what do you think? What's your strategy now for these next months?
It's a big question. I mean, I think for me, personally, my wife and my family, we've decided to, cut back on spending, right? I mean, consumer confidence is down and we're the same, right? So, we're pretty conservative with our money. We always have been. I've been in the same home for 12 years. Don't plan on moving anytime soon. I've been fortunate in life and I've been able to pay down and I own my home outright. So, we bought it for, very inexpensive, at a time when the market was very favorable. And it just seems to us that, keep our expenses low. So, we are, candidly cutting back on some potential vacations and just making some decisions this year. I'm not necessarily worried about my income, but, I am worried about, the country. I think that, a recession, once again, means unemployment. It means less consumer spending. It means pressure. So that's how I'm thinking personally. And then when it comes to my investments, my view there is, once again, that's for retirement. It's time in the market, not timing the market. So, there's some temptation in times like this to say, well, let me sell everything and then avoid a loss and then I'll buy again. But man, by the time you factor in capital gains taxes and just all that stuff, it's like you're just better just to leave your money, let it keep working for you. And I'd be lying if I said I wasn't checking the stock market every hour, the past week or so. But I kind of decided this week I'm just going to kind of like not pay as much attention. I'm only going to focus on what I can control, which is right in front of me, which is my family and my work here at Ferris Capital Partners. So, what I'm thinking about is cutting back on spending, just to be mindful that if we are heading towards a recession, we all need to kind of cut back a little bit. And then the secondary thing is getting very aggressive, looking for residential apartment deals that have good, strong fundamentals and great areas. For us, we're big believers in the southeastern United States. States like Georgia, the Carolinas, and Florida, where you're seeing a lot of population growth. A lot of companies are either here or moving here. Atlanta has a large share of Fortune 500 company headquarters here. Charlotte, big banking epicenter, Raleigh, Durham, a lot of technology, Charleston, defense. And so just looking for those areas that have strong economic demand drivers. And then we're kind of thinking about, those areas, it goes back to recession, not resistant, because nothing is truly recession resistant, but like defense spending isn't going away. Charleston has a lot of defense jobs. So we're going, okay, like you may feel a bit of bite on tourism in Charleston, but it has defense, it has Volvo manufacturing plants. There's a lot of car manufacturers in South Carolina nearby. So things that we think will be less impacted, because candidly, one of the things I'm thinking about is, the car and automotive tariffs are saying cars built in the US. So it's interesting because I have the suspicion that they were trying to prop up American car companies, but I don't think they thought about, Ford and Stellantis and all these different American brands are building cars in Mexico and Canada and other countries. So Ford has already closed some plants in Mexico, for example. They've laid off employees here in the US, but just the same, Toyota, Kia, Volvo, a lot of the foreign car companies do build cars in the US. So, it's going to be interesting to watch which brands are more impacted, but it goes back to, we're just looking for areas that have strong economic demand drivers that'll feel the recession, but will push through because it's not just one industry they're dependent on. So that's what I'm thinking about, just cutting back personally, and then leaning more into the Ferris Capital Partners and looking for more opportunities. Because once again, I have no doubt in 5 to 7 years, any real estate you buy today, you're going to look back and go, man, I wish I bought more of it. That's my prediction.
So what about financing? What do you think is going to happen in regards to bank lending to people?
Yeah, that's a great question. So, the treasuries, which are, sort of the spread between what the bank rate is and what the actual mortgage amount you'll get, went down a little bit last week, but it's now actually creeped back up. So we're watching that closely. We do think rates will come down, and we do think the treasuries will come down. But of course, the Fed is looking at inflation. And if inflation rises with these tariffs, which a lot of people are saying it will, they'll probably hold the line on the Fed rate. So the relief will really come probably from the treasuries, where maybe investors there'll be less coming in, so the treasuries will dip. I think that there's going to be certain asset classes that are going to be tougher to get financing on. Think about retail is a great example. Retail has already been challenged because of the move towards e-commerce, right? Companies like Amazon are taking a big bite of retail. But man, many just, clothing brands, like a lot of just online brands today that, and people are just used to buying online. So retail had been challenged. It actually started coming back a little bit, because it's interesting how human nature works, where it's like, we like the convenience of e-commerce, but I think some people are missing the experience of going into the store and browsing and shopping and knowing what they're buying is actually what they're going to get. Because I ordered a pair of pants online the other day that looked great in the photo, but when they came in, they looked like they were like made for a clown or something. I was like, I literally took them out of the package and just packaged back up and mailed it back, because I was like, I don't know what I thought these looked like, but this is not what I thought I was buying. And so, people like that experience. But I think if you look at consumer confidence, it's already tanking in a big way, given some of the turmoil. And so that means less people out spending money in shops. So I think retail could potentially be impacted, where it's tougher to get loans on retail. Office is having a bit of a resurgent with the back to office work, but office is still challenged. And I would say industrial and like warehouse is doing good right now, although there's been a lot of new supply that's come online. So that new supply is creating rent pressures, but goes back to consumer confidence. Yes, e-commerce is growing, But if less people are buying products from Amazon, that may mean they have to, potentially, shrink their footprint, right? In terms of how many warehouses and industrial spaces. Amazon's kind of a weird example because they're a behemoth and they'll probably keep their spaces and they're typically long-term leases, but other e-commerce businesses will be impacted. So some of these smaller warehouse and transportation facilities may see some challenges. So I would say it's possible that even with lower rates, it's still hard to get approved because the banks are looking at the health of the asset itself. And so if they think that income will reduce over time, say by buying a retail building, they're going to make it more difficult for you to get approved. So it's either going to be less leverage or it's going to be a higher rate that they charge. So, I would say that, it'll become easier for well-qualified buyers and assets that are performing really well to get financing. But if there's a little hair on it, or if it's a bit challenged, it may become more difficult, even if rates were to decrease. But we'll just have to watch and see. It's literally every day seems to be like new news and, something different, right? So it's very in the moment, right? So it's hard to predict.
So you were talking about the treasury. For people who don't know, if you could explain a little bit, what is it exactly?
Yeah, so basically, treasuries are an investment tool that people can invest in, and basically, it's if you think about it, it's the difference between what the Fed bank rate is and what the your actual rate will be. So it's really the money that the bank makes on loaning that money because they have to borrow the money from the Fed. They add a spread to it, and then that's where they make their profit is in that spread, that treasury. So treasuries are often impacted by global and macroeconomic factors. And so those will go up and down depending on investor sentiment. So if people think that the market is getting worse, you'll typically see treasuries go down. If they think the market's getting better, you'll see treasuries go up. So there's 3-year, 5-year, 10-year treasuries, so it really depends on what type of finance you're getting. We typically get 5-year financing on our deals with an option to extend, but that's really what a treasury is. It's really just the measure of the spread between the bank rate and the actual mortgage rate that the bank charges. So it's just a good indication on how the economy's feeling about investment in the future. So once again, typically lower treasuries mean, we're heading towards a contraction or potentially a recession. Higher treasuries mean the economy's doing better. So, Trump said he wants lower rates, which I understand. But, at the same time, it just goes back to the lower rate environment we've had the last number of years was sort of an anomaly. Typically lower rates mean a worse economy. And so I think that's where, be careful what you wish for. We might get the lower rates, but we might be stuck in a recession for, 2 or 3 quarters with limited growth and, unemployment and all these other factors occurring. So, I would say for somebody who's thinking about even just buying a home today, due to all the things we talked about with the cost of new construction, like even at a higher rate, you're not going to lose, in my opinion. Now, you got to be careful, right? If you buy in a very small town that has one industry and that industry is impacted by a recession, that could be a challenge. But if you're in a major city with high population growth and good economic drivers, it's going to be hard to lose investing in real estate, even if it's just for your single family home this year.
So I don't know if you talked to other investors in your circle. I wanted to know what are their thoughts in regards to everything that's happening.
Yeah, it's interesting. I mean, most of my friends are pretty frustrated. If you look at the way that these tariffs were applied, it wasn't super scientific. What they did was they calculated the trade deficit between us and the country we're applying the tariff to, and that was the percentage they used. So we really weren't looking at what tariffs these countries were charging on various products. We were looking at the trade deficit. And so, I think it's natural just, if you thought about it, you say, well, gosh, why are they buying fewer products from us than we are from them? We should balance that. But the reason is the U.S. is, an economic powerhouse. And so it would be odd for us to sit here and think, well, yes, Honduras and us and the U.S. should have no trade deficit. I mean, some of these countries that we've applied tariffs to, even if they took their entire GDP and spent it all on U.S. products, they would still be, many percentage points. I mean, 10s, 20, 30, 40, 50 percentage points still in the red in terms of a trade deficit. So when you've got the world's largest economy, you actually kind of want a trade deficit. It means we're able to buy up all the world's resources that we want to get our hands wrapped around. So I find it a little odd that people are sort of upset about trade deficits, specifically when we're talking about countries that have GDPs that are a fraction of the size of the USA's. So I'm mystified by the whole tariff thing. I think it's going to be a complete fail. The only thing that I think could come of this is that if countries come to the table and start aggressively negotiating, but it goes back to me, tariffs should be used like a sniper. In other words, you're like, okay, we want to protect a certain industry in the US because we think maybe, say, for example, the Chinese are undercutting us. So I think we touched on this on the last podcast, but solar panels, China was producing solar panels below cost and selling them below cost to try to capture the market. And we had US companies that were trying to do it the right way. And we wanted to make sure those companies were protected. So we slammed pretty heavy tariffs on Chinese solar panels. That to me makes abundant sense. We should be looking to protect US industries, but more strategically, and once again, more with a sniper approach. The Trump tariff thing seems more like an atom bomb, just like blow everything up and then we'll work it out. And so, look, man, like, once again, I'm not an economist, but I read a lot. And, even the National Review, which is one of the number one conservative magazines in the US. I mean, it is a hardcore right conservative magazine, came out yesterday, just totally against these tariffs. Senators are starting to ask more questions and poke around. So I don't know, man. It just seems like it's a shock and awe approach, which, I think this deserved a little bit more of a nuanced approach. Once again, there is absolutely a time and place for tariffs. In fact, Trump in his 2016 to 2020 term implemented tariffs, I thought, in a very intelligent way. And if you even look, Biden kept those tariffs in place because, once again, it was strategic. It was looking at industries that we were being undercut or undersold by some of our competitors in other countries. And so he said, enough of that. We want to protect US industry. This just feels like, once again, we just dropped a bomb and now we're, trying to dig through the mess to clean it up. So I may be missing something. I'd be happy to eat my words. And hopefully in 6 months, if we talk again, I would say, man, Richard, I was completely wrong. I hope that occurs, but I just am getting the sense that this is a bit of a, not a super well thought out thing. And that's how it seems. Once again, calculating a trade deficit and then slapping a tariff based on that trade deficit percentage is insane. It makes no sense in any form or fashion. So once again, I'm not a genius, so I'm probably missing something, but it just feels like it's a little bit unorganized and not well thought out. And so that's what's giving me a lot of concern. So a lot of the investors and friends that I'm talking to kind of feel the same way. One or two, that think that tariffs are great. But, look, if you look at the US history, the last time we implemented tariffs in this way was during the Great Depression. And it absolutely caused the Great Depression to extend on for many more years and created a lot of heartache and pain in the US. So once again, I hope I'm proven wrong, but I do think that this has been a mistake by the Trump administration. And I think the implementation specifically has been a mistake. So we'll see what takes place over the next few weeks. It's anybody's guess. I think it's very fluid at the moment. In other words, it's likely to change tomorrow and the week after that and the week after that. It's going to be a lot of change, I think, and a lot of disruption.
Where can people learn more about you and follow you?
Yeah, I think if the easiest place to go to is fulloutinvesting.com or fariscapitalpartners.com. That's FARIS Capital Partners. You can book in a time to talk about these topics or anything else that's on your mind. And those are the easiest places. If my name's in the show notes, you can type that into LinkedIn. You'll find me pretty easily. My last name, there's only a handful of us out there, so you'll find me there as well. So that's another great place to connect.
All right. Thanks, John, for being here. So it was a great conversation. On that note, thank you everybody for taking the time to listen to the podcast, and we'll see you on the next episode. Bye.